What's going on, everybody? Welcome to a Capital Hungry Higher Time Frame Macro Analysis webinar. It is currently Sunday, August 28th, coming towards the end of the business month. We like to do these webinars once or twice a month to zoom out and have an overall bird's eye and macro perspective view of the financial markets, understanding what's going on fundamentally and technically. Now, I always advise that members reference previous higher time frame webinars, as we usually have continuations and our bias is still actively playing out, which is the case in situation with what we're going to be looking at in the financial markets today. We're still looking to play US dollar domination on the higher time frames. We're still looking to play Japanese yen weakness. We're still looking to play the macro information advantage of central bank monetary policy holding the most weight and how this is impacting various asset classes down the line. This means our higher time frame bias of bears on gold, bears on GBP USD, bears on Euro USD, and even bears on the US equity market is still very much active and valid. And our higher time frame bias of expectations of upside on USD CAD and upside on GBPJPY are still very much valid and still very much in play. So let's look at what's going on here. We understand from a higher time frame perspective the reason why dollar has been so bullish after fading out the data and impact and pricing in COVID, where we had the huge increase in money supply, low interest rates, and massive stimulus. That as we had the Feds started to shift and pivot their monetary policy at that time into starting to talk about tapering, actually starting to talk about interest rate hikes, increasing interest rates, and so forth, that US dollar has been bullish on that fundamental reasoning. So we have a few things going on. Respect to higher time frame demand zone and institutional buy area, Fed pivot into hawks, and of course, this being the macro info advantage, holding weight for months, for almost a year and a half now, right? This macro information advantage has had the markets and institutions accordingly price in and adjust order flow algorithmically to be pooling in more liquidity into the US dollar. The reason for this is during times of aggressive interest rate hikes, especially when we're seeing it from major global central banks, and during this period of economic uncertainty with recession scares starting to develop, it really removes any validation or reasoning to be pooling into asset classes such as gold, oil, housing and real estate, and crypto and so forth, or the stock market. You have very high interest rates, you have very high prices on these asset classes at the current moment. And at the same time, you also have uncertainty with the economic situation as rates are going to continue to rise, even though recession scares are starting to develop. So you can see this has led to more higher time frame bullish market structure, of course, forming on the dollar. And not just that, us also having a very, very clean breakout of these previous 102 highs where we haven't broken above here or haven't been trading above this point since literally the year 2000, right? So in a perspective of understanding the fundamentals in play as well as market structure, what we can understand and what we can expect is as long as the macro information advantage stays in play, and especially as we had even more confirmations from Jerome Powell that the Fed will not be pivoting and the Fed needs to continue to raise interest rates until we normalize and keep those interest rates at those high points so it can actually have an impact on bringing inflation down. We're not just going to raise rates and cut them again because that's pointless to do. And they're not just going to raise rates and cut them because recession scares are developing, because inflation is still very high risk. And inflation can crash an economy itself if it doesn't get controlled and if it doesn't get brought down, right? So based on market structure, based on price points of interest, and even based on a little bit of historical repetition, you can see we're starting to break out of higher time frame bear structure. we're starting to create these very strong supports of institutional buy-side liquidity zones at previous price sensitivity areas. We're breaking above what was a key resistance zone, turning into a buy area now. We're having extremely strong bullish price action with minimal pullbacks. And on the higher time frame, there's a lot of potential for us to continue into the 120s, the last key price sensitivity area of interest here, where there isn't much noise, there isn't much price sensitivity, and there isn't much fundamental catalyst in the way from us completing this move going up to 120. Maybe, of course, as we have the market's trend and as we have the market waves get created with various impulse and corrective moves, of course, you can have a quarterly period of correction or a bearish month. But overall, dollar is still looking very bullish on the quarterly time frame. Price action is bullish, market structure is bullish. The fundamentals are also validating that as well. We just want to continue to validate this trend and as well as this bias as we're diving down into the higher time frames, looking at the monthly, looking at the weekly as well. Because right now, from our previous higher time frame macro analysis webinars, there is not much change. The same macro information advantage is in play, the same higher time frame bullish price action, even the same targets of 120. Last time we did our market update, we were just sitting at these last previous highs of 102, 103 area, where we were expected and patiently waiting for the breakout with more rate hikes to come and Fed domination still holding the most weight on a global scale. And of course, the US dollar as the world reserve currency, giving you so much information about how order flow is moving through the markets in its entirety and in its singularity, moving as one. Obviously, why I like to look at the US dollar is because it's the world reserve currency and because of how much weight it holds on a global scale with international business. And obviously, it's your main correlating factor on why GU is so bearish, Euro USD so bearish, and USD CAD still holding some bulls on the higher time frame. Right? Now we're bringing this information together to the monthly time frame and zooming in even more. There isn't really any signs of exhaustion or slowing down yet. We're about to have this monthly candle close in another 3 days, where it has the potential to still be closing at these highs and closing very bullish, or potentially even closing a little bit higher if the sentiment of last week continues to bleed out into this new week of dollar domination, weakness in equities, and obviously strength in the dollar and some of these other asset classes starting to see liquidity fading out of it, like gold, oil, and so forth, especially as we've had some more hawkish remarks over this specific weekend from central bankers. But overall, whether we were observing the price action here on the 1 minute time frame or observing it here on the monthly, our capital hungry concepts are still the same. On the monthly time frame, we can see a very beautiful break out of this bearish structure, respect to this institutional demand zone, a technical double bottom that gets created, a break above that double bottom leg, and ever since that point, just beautiful succession of bullish price action like we're breaking down a 1 minute chart. You have stronger consecutive and more bullish candles, very minor bearish pullback candles where you can have a consolidation for a month or a pullback phase. And other than that, just a succession of bullish price action. You can see from the previous highs, we've also had a very clean break and retest here as well, already collecting more buy-side liquidity from previous high price points and continuing higher. If this monthly candle just continues a bit more bullish, even if we do get another month of just consolidation or potential pullback phase, it's still perfectly in relation to higher time frame bullish structure, intraday bullish structure, and this sequence of events as we slowly continue to chug into the 120s over the periods of the next months going into the new year as well. Obviously, we only have a few months left of 2022. Extremely crazy how fast the last couple of years has gone by. Besides just this trading content and financial markets, I'm extremely blessed with the situation I'm in of running this capital hungry service, of being able to do this day in and day out, something I'm very passionate about. And I just want to share my gratitude of all the people showing support for Capital Hungry and being a part of the service or enjoying the service, learning a lot, making money through the markets, and growing their knowledge, skill set, and network together as we're a part of this journey. I just want to show you my gratitude, say thank you for appreciating and supporting the Capital Hungry service, because obviously it wouldn't exist without the clients and customers who enjoy the service and support the content. So I just realized that we're almost coming towards the end of 2022 and how fast it's been. Now everything's going by as a blur, but it's always good to slow down, show that gratitude and appreciation for the people that make this possible. And I just want to do that there quickly. But anyways, still see dollar domination. Very strong double bottom in this area, showing less sell side liquidity at an institutional demand zone from 2018 lows. Very nice break of structure with the shift in a fundamental information advantage and the Fed starting to give pivot signals. The reason for this entire upside, the reason for this bullish price action, the reason for more bulls to come is, of course, the macro information advantage of the Fed's increasing rates, tapering stimulus support, and continuing on that hawkish path to bring down this very high risk economic inflation that was also created by them, human greed, and human greed pushed to the extremes. Now, when we're diving down into the weekly time frame, this is just going to be further supported. We're seeing that those minor monthly pullback phases we were observing, or those minor monthly bearish candles, are nothing but these pullback or corrective phases on the intraday timeframes, either being some of these pullbacks or being these corrective consolidations. When we're looking at the sequence of events, it's looking very similar to what we saw a few weeks ago during the May, June, July period here, where we had buyers print a very strong consecutive high, an aggressive correlated pullback phase that didn't cancel out the bullish price action, and then buyers come back to revisit that high, a bit of consolidation, and a continued breakout that led into the new higher highs. Right now, as long as we're trading above these previous candle bodies, and especially trading above these wicks, there's a lot of potential where even if we consolidate to start out the new month of September or have a little bit of a pullback for the month of September, that there's still a high probability that if we don't fade out or cancel back, closing back below 108, that we have a lot of potential to continue to the upside on the dollar. The market pricing in more rate hikes to come, the market pricing in a decreased chance of Fed pivot and Fed cutting rates, and the market having to adjust and deal with this cold, hard reality that they can't keep buying stock market and equity shares and holdings, that they can't keep buying into oil, that they can't keep buying and investing into the real estate market. And we're finally going to have a cycle shift, doing a full circle all the way around from that stimulus and prices so high and doing that full economic cycle shift. Regardless, nonetheless, if we see dollar continue bullish in terms of its price action and technicals, from a fundamental reasoning, all this tells us is the market is further pricing in that information advantage of more rate hikes, hawkish tone in the inevitable actions by the Federal Reserve to come. That fundamental correlation and also this technical correlation, this will mean easily continued downside on GU to potential parity points of being 1-to-1 with the US dollar. Euro USD holding below the parity point and continuing bearish, gold continuing bearish back to the 1680s and potentially even lower, having a corrective phase in terms of technical repetition, and US 30 having a corrective bearish phase, while USD CAD being a lot more bullish. Right? So to summarize, dollar price action, quarterly, monthly, weekly, bullish. Market structure, bullish. Fundamentals, bullish. Target still 120s, previous price points of interest. Still seeing buyers print higher highs, minimal pullback phases, continuations to the upside. Dollar domination continues to hold as your world reserve currency and business currency. Investors continue to pool in more demand into the dollar, or more liquidity into the dollar due to the demand being there, rather than these other asset classes, thanks to them following the cartel of the currency being the Federal Reserve, and obviously their more hawkish tone. Now, Understanding that on the dollar, we can really easily summarize pairs like GBP USD on the higher time frame and Euro USD because we understand the dollar as your world reserve currency and global business currency is going to hold a lot more weight when you're looking at these various correlations and you're looking at these other currencies on a global scale. This is the main reason why on the higher time frame you of course have GBP USD bearish and of course Euro USD bearish. Now, when we're looking at GBP USD for the first example, there's a lot of high probability of us coming to this parity point being one-to-one equal with the US dollar over the extended period of days and months to come. You can see in terms of market structure, we're still respecting higher time frame bearish market structure across the board as sellers from this point now are leading into lower lows. And very similar to previous sequence of events, you can see that we had this extended downside move of sellers printing consecutive lower lows. From these lower lows for a period of years, you enter this aggressive pullback corrective phase. Here you can see that it was more of a pullback structure, but you also had a very hard resistance being formed until you formed your way to the downside. And here you can see it was retest of previous lows and more of a consolidation in support zone. My expectations now with dollar domination, how we had the previous quarterly candle close below these candle bodies and lows, is that we can at least go fill this wick and range created from the 2020 pandemic and also potentially continue lower, giving us another large sell side squeeze as highlighted in these box situations into even lower lows, which can potentially take us into this parity point being one-to-one equal value of GBP, British pound, sterling to the American US dollar, right? So one, dollar domination and the fundamental correlation of Feds in control is still very much valid. Two, historical repetition is still very much valid. Three, respect to market structure as well as bearish price action on the higher time frames, very much valid. Four, compared to this situation here, we're finally starting to get a break of the previous lows with potential reasoning for another leg to the aggressive downside there. Right? So on the quarterly chart, GBP USD technically bearish, fundamentally bearish, price action bearish, market structure bearish, historical repetition bearish. Any short-term optimism with GBP or Bank of England raising rates, even though that's a positive for the British pound, you'll have lower time frame and intraday impacts, but it's really just going to be price setups as those moves will get faded out because US dollar domination is going to hold a lot more weight, right? So bringing that information together to the table on the monthly chart, you can just see that further highlighted zooming in now. You can see we've had already this respect to previous sell side liquidity zones with this technical double top that's forming at 1.4 flat. From there, we've also been creating stronger, higher time frame bearish market structure, where even if we have some type of fundamental catalyst giving us huge retests of 1.25, it would still be very bearish. We're having significant breaks below these candle body zones, which lines up with 1.25, where even for the new quarterly or monthly period, retest in these areas is still bearish, and we have potentials to revisit this wick, and of course the one-to-one parity points being equal to the US dollar. Very strong bearish price action with consecutive bearish candles, minor bullish candles being pullbacks, breaking below consecutive lows and printing lower lows on your intradays at higher time frames. Very similar repetition to this double top or sell side liquidity that was generated in this area. Bearish market structure that started to form, and then you started to get the break below the previous leg and continued stretch. When we're highlighting the sequence of events in terms of historical repetition, you can see, looking in the blue box here, at these previous lows is the situation we are at. Right? bringing together this information on the weekly time frame as well as the dollar correlation. Beautiful, beautiful bearish structure. Even on the intraday time frames here, sellers consecutively printing lower lows. Only having these short-term pullback phases. That is just sellers exiting in the short term, pulling price back up to more favorable sell side institutional zones, dollar domination continuing into lower lows. Very similar to the dollar correlation, you can see we've already had a significant pullback phase to collect more sell side liquidity. We're already starting to break below those lows. New weekly candle holding below these lows or the monthly closing below and the next month retesting or breaking below has a lot of probability to revisiting pandemic crash points. And also being very similar to the upside move getting mirrored here, where we finally broke below that liquidity zone, you have a lot of free fall space coming down to 1.16, 1.1, 1.16, 1.14. So it's beautiful when you first understand the fundamentals and technicals impacting the dollar as an individual currency because of how much weight it holds on a global scale and how you can bring that same information together, understanding what's going on GBP USD, Euro USD, USD CAD, and even gold, relating the fundamental correlations to gold of the central banking actions. Euro USD, similar idea here, where understanding what's going on, I don't have to explain it again. We have a lot of potential going to 0.95, 0.90 flat, right? ECB differential of interest rate to the Federal Reserve is a lot larger. ECB is just coming out of negative interest rate territory recently. You can see very similar to this situation, when you had sellers not significantly break these lower lows, you had more of a sell side liquidity zone created before finally having these reactions and continued leg to the downside. So now what we can see is we've already had this technical double top, very similar to GU, inverse of dollar. We're having extremely strong bearish price action and structure forming. We're breaking below some of this corrective pullback bullish structure, as well as below key support zones in previous higher time frame lows. We're already sitting at the parity point with a very large potential bearish candle close on the monthly, and the quarterly still having a lot of potential to go to 0.95. Macro information advantage of Fed domination and dollar domination still in control. Any type of ECB rate hikes or euro optimism is just short-lived and gets faded out as dollar domination takes over. Very similar to GBP USD. Monthly chart further highlighting the break out of some of this pullback structure, break below that support zone, bearish price action and structure forming, and of course targets into 0.95. So Euro USD, to summarize, ECB still has a big rate differential compared to the Fed. Hawkish Fed tone is going to hold a lot more weight on a global scale due to US dollar domination as your world reserve currency. Higher time frame Euro USD bearish, price action bearish, structure bearish, weekly, monthly time frame bearish, intraday time frames bearish. No reason for us to look for reversals. No reason for us to really counter trend trade. No fundamental validation for higher time frame euro upside, especially against the dollar anyways. Now, this correlation of dollar movement to Euro USD and GBP USD is very easy to understand because you obviously have the US dollar within these currency pairs. But when we're looking at equities, when you're looking at gold, which obviously you have the US equities as a different asset class, it's not a currency pair, or you're looking at gold as a precious metal and it's not a currency pair, it's not going to be a one-to-one direct correlation to dollar movement. The correlation between what's going on in dollar and what's going on in the equity markets in gold is in relation and correlated to the Fed central banking action. You could use the direct correlation of technicals and understanding of fundamentals one-to-one almost with Euro USD and GBP USD to the dollar, because both of these currency pairs house the dollar within it. And you're obviously relating it from one to the other. But gold is its own beast. Equity market is its own beast. Dollar movement can tell you a lot of information about market sentiment for these trading instruments like gold and, of course, equities, about what the market is holding most weight to, of course, being the Federal Reserve rate hikes. But you're not going to see directly one-to-one correlated movement of dollar to gold or dollar to equities. Okay. Nonetheless, we have been on a higher time frame bearish bias on gold over the last almost 6 to 9 months. Ever since we've had this double top at all-time highs at 2075, we've had Russia-Ukraine tensions priced in, high inflation priced in, any weak economic data priced in. What we have been expecting is very similar historical repetition to the 2008 GFC financial crisis. Now you can see this monthly candle has even had a beautiful, beautiful pullback, generating more liquidity from the 1800 sell side liquidity zone, giving us even higher probability of historical and technical repetition to that 2008 period, right? So one, fundamentals of the pandemic, high inflation and low interest rates priced in during this initial run. Very similar to what we saw here during the 2008 GFC, prints a very strong high, also based on the candle bodies there. We can also see for an extended period of time, we have this indecision and corrective structure coming all the way down into this same demand zone across the board, where it was the 1680s here, and it was roughly like this 1580s, 1600s here, right? This, you have your period of indecision during the economic crisis, still uncertainty with monetary policy and what the central bank is going to do, and you don't break that demand zone instantaneously. You have a bunch of reactions and ranging in that area. This is all the way until you have one more bullish rally to sweep the highs and collect more sell side liquidity. And then you finally start to get the Fed taking action and combating inflation and shifting out of the previous monetary policy cycle we've seen. Here, they were raising rates. Here, during the 2013-2014 phase, we started to have the taper tantrum take place in interest rate hikes. You can see all of the fundamentals for upside at that time got priced in, and you start to create some stronger bearish price action on the higher time frames and on the intraday time frames as the Federal Reserve here stops pumping the markets, starts tapering stimulus support, and you have interest rate hikes come shortly after. And in this situation, we had Russia and Ukraine tensions priced in, inflation priced in, Fed start to taper stimulus support, and interest rate hikes that followed, right? We have a lot of potential of still coming down to these 1680 range lows. And if we have the Fed continuing to hold weight and stick by their bias given by Jerome Powell at the Jackson Hole Symposium of more rate hikes to come, keeping rates up for an extended period of time, no Fed pivot, needing to bring down inflation, continuing to raise rates even if recession scares develop because they have no choice. And we have a lot of potential to still for gold to go down to the 1680s demand zone again and potentially turn more bearish, having a bearish market in corrective phase until we potentially retest the 1400s, 1500s before we possibly have World War III and a China invasion of Taiwan mid-2023, end of 2023. But overall, historical repetition, check. Technical repetition, check. Dollar domination, check. Fundamentals of no more Fed support, check. All the fear that brought us to 2075 priced in, check. Potential to revisit 1680s, check. Intraday bearish structure still being respected, check mark. Fed recent hawkish sentiment, check mark. Okay, so still a lot of potential for bears on gold. Just want to keep in mind that we want to maintain holding below the 1800s now. We want to respect and create this more refined bear structure. We want to have maybe a pullback and start revisiting 1700s, 1680s, and continuing even bearish in this structure and run that's being created here. Any fundamental fear of bad economic data reports, short-term impact gets faded out. Taiwan, China headlines, noise, minimal impact gets faded out. Russia, Ukraine, priced in, no major impact. No other major fear, uncertainty, or doubt impacting financial markets, bringing any new information to the table. Now, US equity markets. A lot of potential when we're looking at US equities and the shift in, of course, monetary policy sentiment, that we can be revisiting these previous pandemic highs in a lot more aggressive fashion. One, all-time high price points hit, record high price points hit. So let's understand this. So think about it. I don't know why that got small all of a second, but it's okay, right? Here, the reason why investing into the stock market was so favorable during the start of the pandemic was low prices, right? You just had the stock market crash to historical low prices in a singular period down to 18,000. That's one, buy low, sell high. Low interest rates, Fed support, money pumping, inflation, which wasn't that high risk at the time, whales riding the wave. And I talked about this in other webinars. Now, the same conditions that made investing into the stock market so favorable at the start of 2020 are the opposite. Now we have high prices. Now we have higher interest rates. Now we don't have any more Fed support in pumping of the markets. We don't have any more money printing. We don't have any more safe inflation increasing the prices of everything. It's high risk. And we don't have whales riding the buyer wave anymore. What we have is all-time high prices, higher interest rates, less money pumping, no more Fed support. You can see this quarterly candle obviously still has another month, but a huge rejection after that bear market rally, not correcting this engulfing candle, huge bearish engulfing candle, potential for next month to revisit these lows and continue even lower to potentially 28K pre-pandemic highs. Right? There's more demand in the dollar now due to the shift in the Fed monetary policy than there is in these asset classes such as stock market, oil, real estate, gold, and so forth. All of the reasoning that made it so, like this reasoning here that made it so favorable to invest in the stock market was also the same reason why oil was so bullish before the Russia-Ukraine tensions, and they scapegoated that. It was the same reason why the housing markets in North America were so bullish at the start of the pandemic and continued for the last couple of years. Same reason why gold was so bullish as well. Right? But we're getting a shift in that policy sentiment. When you're looking at the monthly time frame, this monthly candle, obviously it'd be fantastic if it engulfed the bullish candle, but we're still respecting this higher time frame bearish market structure that's forming. And we still potentially have these lows to revisit and more refined to pre-pandemic highs at 28K. We couldn't break back above this very key liquidity zone at 34K, 34,200. And we're having this monthly candle completely flip bearish during the last few days of its closing due to a fundamental reason of the Fed's confirming no pivot to come. If we can't break back above 34K, there's a lot of potential for us to drive down to 30K again and potentially even 28K as the main market sentiment of fear is starting to set in from an economic perspective. This isn't fear of some pandemic or monkeypox or lockdowns. This is investor fear that the Feds are not going to pivot and they have to cash out of their stock market holdings. VIX is respecting a higher time frame support at the 18.5 to 20 handle. Dollar domination continues. Bearish structure still being respected on US 30. bear market rally starting to get faded out. All of the reasoning that made the stock market so favorable to invest in here is completely the opposite here. Okay. Now, last but not least, GBPJPY. Now, when we're looking at the Japanese yen, individually extremely bearish. Of course, GJ has been ranging as we've had some indecision of GBP weakness versus yen weakness, but overall, GJ is not breaking its higher time frame bullish bias. Yen has a lot of potential to go down to 670s flat and 68s, potentially lower than that as well, right? Breaking below very key demand zones, huge, strong bearish price action. Bank of Japan dovish, keeping interest rates in the negative as they actually want some inflation in their economy. And of course, we still have them keeping their unlimited bond buying program going and not shifting out of that monetary policy sentiment. You can see aggressive bearish runs on the yen individually are very common. We've already had a lot of sell side liquidity generated, bearish price action, bearish fundamentals, and so forth. So that fundamental repetition of the 2008 period is still very much active, where GJ still very bullish on the higher time frames, right? Yes, maybe this quarterly period is going to be a one-off situation where we've been ranging similar to this situation and what we have going on here. But overall, on the higher time frames, we still have respect to this institutional demand zone from the 2020 pandemic grab. We still have a break out of higher time frame bearish market structure forming. We have a break out of this historical repetition of bearish structure. We had that technical double bottom created at these lows to grab some more buy side liquidity. We have stronger bullish price action and bullish structure forming on top of the rate differential of more hawkish Bank of England and rate hikes to come from the Bank of England and a more dovish Bank of Japan. Obviously, it's very common to get these aggressive pullback phases and consolidation phases. An example I like to show everybody is this post-2008 run. After the 2008 GFC was priced in, and you, of course, had a break out of this bearish structure, a technical double bottom formed at this institutional demand zone, you had a beautiful, beautiful run of bullish price action all the way until we had a catalyst come into play to cancel it out, which was Brexit, right? We don't have any catalyst coming into play to cancel out the bullish price action yet. So seeing some of these bearish corrective phases, whether it's a month, couple of months of consolidation, or indecision, is not abnormal at all, right? When you're looking at the higher time frame structure, we could still easily come to revisit like 155 and still be very bullish on GJ. GJ fundamentally, technically, in terms of historical repetition, is still very bullish. If we're trading back above 165s, a lot of potential for upside and another leg up going to 175s and 180s. We would need new fear, uncertainty, and doubt for GJ to be breaking the structure or turning higher time frame bearish, or we would need aggressive rate hikes by the Bank of Japan, which isn't happening anytime soon. Okay? So anyways, to summarize, our higher time frame macro information advantages and bias are still valid across the board. Our historical repetition, still valid across the board. Still looking to play dollar domination, yen weakness in terms of currency correlations. Still looking to play the fundamental macro sentiment of the Fed's actions and other central banker actions as the main fundamental driving factor on these financial market asset classes. Make sure to watch previous higher time frame webinars to get more information, to see how we've been tracking these pairs, how we've been playing this bias for an extended period of time over the last almost a year and a half, 2 years now.